In this video, we are going to talk about Robert Kiyosaki investing rules. So before starting this video, please like this video and subscribe to this channel for our future updates. Robert Kiyosaki is an author and businessman from the United States. He is the author of the best-selling Rich Dad, Poor Dad series of books. The Rich Dad is a fictional character who is the father of the author's best friend, Mike. At the age of 13, the Rich Dad dropped out of school. He owned businesses, making him one of Hawaii's wealthiest citizens. The story's Poor Dad was the author's biological father. The Poor Dad was a well-educated man who worked for the government in the education sector. Both made different choices in life, resulting in one being wealthy and the other failing to do so. Robert Kiyosaki is a multi-millionaire with a net worth of more than $80 million. He has worked in the fields of real estate, oil, and mining. He's also the founder of Rich Dad Company, a company that provides training and seminars on personal finance, investing, and industry. A quick financial disclaimer: if you need tax or investment advice, you should consult a specialist. The information in this article is given solely for educational purposes. Let's get started. Learn about the 3 different types of income. The majority of people are unable to determine where and how their money comes from. They don't mind how the process is carried out as long as they get paid. In the long term, this is terrible because you won't know what keeps the money going. There could be potential events or issues that impact your income, and you will be unsure what to do. According to Rich Dad, there are 3 different ways to categorize profits. There are the following: paid income. This is money earned from work. You're trading dollars for your time and effort. This form of income is also the most heavily taxed of the 3. Profits from paper assets or capital gains is referred to as portfolio income. Stocks, shares, and mutual funds are examples of these. It is the second most heavily taxed item after earned income. Real estate, dividends, and distributions all contribute to passive profits. It is the least heavily taxed of the 3. This form of income was suggested by Kiyosaki in his book, Rich Dad, because of its low taxes and potential for higher returns over his lifetime. Make an effort to educate yourself. This isn't the kind about education you're thinking of. You are not required to attend costly business schools or seminars. You can begin by searching the internet. There are several resources available on the internet to assist you in learning more about investing. People who are illiterate in the field of investing are the ones who remain weak. Self-education is inexpensive, but it can also be costly. You should search for prominent people in the investment world who are offering lectures, courses, and lessons if you have the time and money to learn. The best place to begin is by investing in yourself. Invest in assets rather than liabilities. Do you consider your car to be an asset? If you think you should, you're in the same boat as me when I first read Robert's first novel. A vehicle, in his opinion, is not an asset since it depreciates in value. For me, this was a big eye-opener. Consider how you should spend more in appreciating assets rather than throwing money away on depreciating assets to maximize your income. Many materialist and status-oriented goods are unappreciative. Automobiles, luxury handbags, high-end smartphones, and designer clothes are among them. Both of these items will not produce income for you, and their value will drop dramatically over time in many cases. Real estate is one of the main assets he concentrates on. How would you transform a depreciating asset into a wealth creator if you don't have enough money to buy real estate? Using a rental car to produce revenue is an example of this. So, instead of fantasizing about your dream holiday, a new car, or another way to impress your mates by keeping up with the Joneses, consider your financial goals. If you start putting your money into income-producing properties, you'll have a better chance of taking a dream vacation without breaking the bank. Make a passive income out of your regular income. People who are just starting out in their professions gain money by working. The majority of people simply save their money. Others, on the other hand, use their earned income to invest in instruments that generate portfolio or passive income. When you amass wealth through work, keep in mind that you can only do so for a certain amount of time. When you get older, your work productivity continues to deteriorate. You'd have to stop working, and your salary will stop as well. Rich Dad advises turning your earned money into passive income as soon as possible. It is taxed at a low rate, and the money you make has the potential to last a lifetime. It is entirely up to you if your investment succeeds or fails. Investing isn't a difficult area to get into. You might think it's just for the clever and cunning, but that's not the case. It all boils down to being prepared. You don't just jump in with both feet and start investing. That's how you'll struggle. As a result, investing has a reputation for being difficult and dangerous. People have a tendency to act rashly and invest without planning ahead of time. They end up wasting their money and telling everyone how difficult it is to do so, when all they wanted to do was take their time and learn about the sector before making a decision. Investing isn't a quick way to make money. It all comes down to patience and waiting for the right opportunity to make a profit. It's tedious and time-consuming, but this form of investment usually pays off. You become wiser as a result of your mistakes. You have to make mistakes if you want your investments to succeed. You begin by making small investments. You won't lose a lot of money this way. Find out how it went and what mistakes you made. Then gradually increase your investment size. As you progress, you gain insight from the interactions you had at the beginning of your small investment. This will boost your morale and increase your investment success rate. It is important to plan ahead. The importance of preparation cannot be overstated. You won't make hasty or dumb investment decisions if you're prepared. Don't try to forecast when the next financial crisis will strike. Rather, be the one who is ready for something that can occur. According to Rich Dad, you should concentrate on what you want, be aware of what is going on in the present, and seize any opportunity that presents itself. There are numerous services available to you in your immediate vicinity. All you have to do is put in the effort to find them and learn from them. Money finds good deals. You will find some good offers that are way out of your financial ability once you have made your preparations through education and practice. The issue will then be how to collect the funds necessary to take advantage of the good deal. Rich Dad told us to seize any opportunity and concentrate on our goals. So, how are we going to collect the funds? All you have to do now is find people willing to lend you money. Why will they hand over the cash to you? This is where the forethought pays off. You made an investment in yourself, because you have the necessary skills, qualifications, and experience. People will have faith in you. People want to put their confidence in people who are professional and confident. Calculate each investment's risk and reward. Every investment has its own set of risks. You should learn how to pick the ones that are the best value for your money. How do you spot the dangers? By gathering information about the investment. You should investigate all aspects of the investment you're making. Company efficiency, management, assets, venue, customer reviews, and many other factors are examples. When you identify the threats, you are better prepared to deal with them if they occur. It also aids in the selection of the best investment and decision-making. When the market is in turmoil, it's a good time to buy. Investing is based on the principle of buying low and selling big. Investors, on the other hand, let their emotions get the best of them when a financial crisis hits. They get rid of everything they own and leave the market. According to Kiyosaki, now is the best time to invest because you can earn more money. Some businesses have weathered many crises and continue to thrive. When the market improves, your investment can pay off if you make the necessary preparations and analysis. Last but not least, the book, Rich Dad, Poor Dad, by Robert Kiyosaki taught us that even if you don't have a college diploma, you will succeed in investing. Rich Dad was a high school dropout who started and eventually flourished in his own business. Poor Dad had a college diploma and a government job, but he was unable to amass money. Both of these tactics will teach us something and help us take action. Recognize that you can make several mistakes along the way, but use them as learning opportunities to propel your capital. If you're wondering who the Rich Dad was, he was based on a real-life figure called Richard Kimmy. Richard Kimmy was the owner of a Hawaii hotel chain. His hotels catered to both locals and tourists searching for low-cost lodging. Alan, his uncle, took over the company after he died. What do you think about our video? What do you think about these rules? Let us know in the comments below. If you enjoy this video and want to hear from me again, be sure to hit that subscribe button and turn on notifications before you go. Thanks for watching.